Welcome to Get Serious. I wanted to go over an update on really the last infill lot that we have in our portfolio. This really tricky one that we've had in Tennessee. I wrote about it in the Serious News newsletter that goes out Monday mornings, but I wanted to cover in a little bit more detail some of the story on the podcast today. I know I've shared various updates about this property and various techniques that we've done, but because we finally went under contract, actually this is the second time we've gone under contract, just the first buyer bailed within about 24 hours of signing a few months ago. This one appears to be much more solid, so I wanted to go over kind of key summary and takeaways of where we were at here. So the kind of rehash of the situation was that we funded a roughly 2-acre infill lot. It was actually split between two different APNs, but they were bordering each other, so it effectively served as one core lot. And this was in deep rural Tennessee. I mean, we're talking even 2 hours outside of Nashville, somewhere in between like Nashville and the Knoxville area. So activity wasn't great anyway. There was significant variance in the market, but we thought that, while it wasn't lakefront, it had lake view. There was, no one was going to be able to build across the street in front of it. So, you're going to get, kind of a nice sloped view of this, pretty beautiful Tennessee lake. And so we thought, hey, this is a bit more of a superior feature here. And based on comps at the time, again, this was late December of last year, when it was in a bit of a mini bull run. We had a lot of cash exits around that time, so we were looking to deploy more capital. We had less acquisitions coming in, and comps look like we'd be able to conservatively move it for 55 to 60K, buying at 35K. And we built in a preferred return into the funding arrangement that if the property didn't sell for at least 70K, which was what we were going to list it for, and the realtors thought, hey, there was a chance they could do that. They were also more of the mind, hey, around 60K is probably more realistic, that we'd get the first K of profits on the deal before any funding splits came in. So that's just a route that we could preserve some upside in cases where there was more variance in the market, though notably, preferred returns don't protect you from downside. They're just upside protection. So that has worked to variable results for us. I'm really pretty opposed to doing any of those arrangements going forward, because that usually just means, hey, this is a more inferior asset, which we have struggled with more routinely, especially over this last, these last 6 to 8 months. For some of those. So I wouldn't be too keen on operating from that standpoint anymore. And we had a really solid realtor team and very communicative. They had a number of folks involved, one of the more solid brokerages in the area, but it wasn't getting a lot of activity off the bat. And then, within 2 or 3 months of listing, after, I want to say 1 or 2 price cuts, we did get a 55K offer. I think I've mentioned this before. It's going to be cash close within 3 weeks. Thought, okay, this is great. But then within a day of signing, like I mentioned, they were out doing a site visit, and a neighbor in that particular lake community said, hey, this property is just not buildable, even though they have zero proof of that. And it scared off the buyer. We weren't able to recover them. And then there was just really minimal activity, a handful of looser potential buyers, but nobody that stuck. And so we were just cutting price again and again and again. And after a record 9 price cuts over the term of our original 6-month listing agreement, sometimes it could be more of a broker issue. I really didn't think that was the problem there, just because their communication was so solid, the marketing was solid. It was just a tough market. Plus, it didn't help that, we didn't realize some of the COVID boom reversal issue at the time that we had bought this property. Plus, the tariff and trade war situation happening was not going to be helpful either. And the variance in the market was just coming back to bite us in a harsher format than we were anticipating. And there were some more questionable comps when we first brought the property And again, this kind of comes back to that lesson I remark on all the time, and I've learned the hard way a number of times here, is that anything south of 2 acres, price per acre really goes out the window. And you can actually expand that within infill lots to cover whatever acreage that you're looking at. If you're looking at, a subdivision of, 3 to 5 acre properties, then price per acre really isn't going to come into play then either. Like the infill subdivision that you're in is going to determine more of the underlying value on a lot by lot basis, kind of regardless of features. And sometimes certain features can be, extremely superior. Maybe you do have like the most premier waterfront property. You have to keep that in mind. And so you want to find the relevant comps there. But in general, like for this property that we bought, which had, relatively superior characteristic, lake view, but not lakefront, we thought, hey, we were going to be able to outperform the market a bit compared to what had been selling or what was on the market that just seemed more inferior. But in reality, we should have been much more conservative and just assumed, hey, we're going to be selling this property closer to what the bottom of the market appears to be, which was around the 3K mark for certain lots that were even, substantially smaller, closer to like a half acre, maybe even an acre of land, and in just a worse location. So we thought, hey, we have enough data here that seems to imply, this 55, 60K range, which again, we did get an offer at that level. It fell through, unfortunately. And so we just had a price cut and get closer to the bottom there to get any activity. And just, our days on market was increasing, people seeing all those price cuts. Like it was really black mark on the property itself. Plus, I tried to take more of the marketing into my own hands as well. My team, we set up, hey, get neighbor letters out here, reach out to all, local LLCs that own land. Let's find all the builders within like a, 2-hour radius of this rural area. And I cold them, cold texted, cold emailed multiple times. Got actually a handful of them to go visit the property. None of them stuck, unfortunately. But, really, really aggressive marketing for such, relatively cheap property for us. 35K buy was, amongst the lowest that we do. Now I prefer to do a 50K plus purchase price, and anything below 50K now it's a bit more of a question mark. But nevertheless, it's like, okay, we have to still find a way to move this inventory one way or another. And like these just endless price cuts on the MLS just aren't really moving the needle here at the same time. And so as we were coming up on that, 6-month term for our listing agreement, we had used this technique successfully twice in the past of just, if the broker was more the issue, we could just have switched brokers. But in this case, you're like, hey, let's, how long do we need to take it off the MLS in order to reset the days on market timer? And some areas are longer than others. Usually it's closer to like 30 days. In this case, the main MLS in Central Tennessee was only 5 business days. And I also requested, okay, our initial drone photos, this was done in the middle of winter. There's just not that much foliage. So I hate throwing more money at deals that we were already going to be losing money on. But it's like, okay, like an extra $120 to get fresh drone photos. Let's go ahead and do that. The better greenery. Let's freshen this listing up and then, reset the days on market time or just take it off market and, try to get it back on so we can get some fresh eyes potentially on this property. And I also tried to renegotiate the commission on this too. That can be another tactic because it's like, ultimately the problem is on us. Like we're the ones who funded the property. So you can't blame anybody else's market assessment. But like at the same time, and the real estate market changed as well too. Like the realtors, they were really plugging in, hey, hey, this thing, like, no way it's going to move less than like 55K. And then, they kept kind of moving the goalposts a little bit. Yeah, it's just slow market. You got to wait for things to come up. Here's the median sales time. And like, we were just blowing past all of these markers. And by the time, we had cut our price down to what we bought it at, 35K, it's a 50% drop in pricing. Cutting a price in half, like it's a brutal assessment, right? Like everybody was wrong on the deal in terms of what we thought was going to get attention. So, I tried to align a little bit more with realtors when possible there of like, hey, can you work with us a little bit here? We're going to be losing money here, just, being upfront, to buy at least a little less pain. And we got them initially down to, okay, just like a raw 4%. But as I was signing the contract again, it was a little bit more handshake, and it went back up to 6. And again, with the NAR dealing, like, it's a little hard because you really can only define the sell side commission, and buy side is just negotiable regardless. But that was a tactic I was trying to do as well. And so within a week, fortunately, or just about that, once we relisted, we actually got 2 offers, one an owner financed offer, and I dropped it another 5K. I'm like, if we're coming back here, I looking at the other comps again, it's just going to be tricky to try to get anything more here. Like, I need to get this off the books. Like, we might be looking at a 10 to 15K loss here, but one way or another, this thing needs to sell. Plus, there was actually a neighboring, like a lot that bordered our property that was also listed for sale, another half acre that was listed for 25K. And so, we were down to 30K for 4 times the size of the property, plus better view. So, it did make sense for potential buyers to consider, hey, I can get that extra half acre and have, extra road frontage as well, just buying, both of these listings at once. And fortunately, one of these offers came in. The owner finance only wanted ours. Since we only do, we'll sell notes if we purchase, didn't want to do that when we had a cash offer in there. And they came in at 25K, but the buy side agent had indicated, hey, these buyers will move up to full price, plus they also want to buy that other half acre. But both of these offers were contingent on a state septic permit confirming a 3-bedroom conventional septic. So that is still a big question mark. Seems in our favor based on our understanding of the topography that that's not going to be a problem. And again, this is a lesson I had learned in Tennessee. It's one of the most stringent states in the country. Most buyers for anything residential are going to want a solid soil test at the minimum, usually a state septic permit confirmed. We've done this in the past. Take quite a while to do, so we're on a 60-day timeline. Fortunately, the buyers are covering all of that on their own, but all we had from a soil test perspective was this soil test from like the late 1960s. But, in this rural area, this planning and zoning department said, hey, that's still going to be fine. But in reality, going back, especially for infill lots, because if you mess up septic like if it doesn't come back solid and your data is just not that recent, like, I just wouldn't have funded the property unless, we would have eaten the cost, just to like really confirm that, just to ensure, okay, we're 100% certain that we are not wrong on this. It was just more of a rushed judgment, trying to move cash, and we thought, hey, there's enough here that we think it's relatively low risk in the build outs in the area. But, that's still a contingency that we have to work with. And presumably we'll get the copy of that in case it doesn't come back at 3 bedrooms. So the realtor seems to think, okay, it's going to be no problem to get that, but, you never know until it's in. But again, fortunately, the buyer is covering all that cost, plus we're splitting title costs. And so that helps a bit more. And then, and then they also requested, at least for commission, they wanted 3%, and so we already had 3% for the sell sides. It's still going to cost us a bit, but at this low of an exit, it's really just about a little bit of damage mitigation anyway. Each percent is like $300, so it's not that much of a killer, but like all told, including allocated overhead for this deal, which again, generally for every deal that we do, we have, roughly $3,000 of overhead attributed to each deal. So we have to hit that hurdle on top of whatever our purchase price was and the various closing costs and commission, et cetera, for whatever the net is. So, this one's going to be looking to be like a roughly 10K net loss. I thought it was going to be trending closer to 15 to 20K based on how things were going. Again, knock on wood, the septic permit works out. But, this has been a really nasty lot that we're mitigating the damage as best we could. And like I mentioned in the newsletter, this lot combined with that absolute auction property in Tennessee, they could have been a combined 60 to 70K net loss. So, the fact that their combined result, again, assuming this other one goes through, it's still going to be like just barely profitable net for us across both, feels like an absolute miracle, considering I thought both of them were going to be significant losers here. So, these were some of the two worst properties that we've ever purchased. Major lessons there. And again, Infill, I talked about in the newsletter, this property, and then another nasty one in Texas we did last year, almost 18 months ago, were our worst properties to date by far. And so it just has made me question doing infill lots really anymore. My bar is just so much higher because, again, if you mess up on them or the market changes on you, there's no recourse. There's only a residential buyer. That is it. There's really no other option for the land. I guess somebody could buy it for spec usage, but even that'll be residential later on anyway. So just the risk is so much more significant there from a downside perspective. And again, our track record now is speaking for itself, even though we still have a decent net positive on infill lots that we have done. Our two biggest losses to date are both infill lots. So just, I'm more skeptical about pursuing those again, especially in these COVID boom reversal markets where demand for housing is just more questionable and probably going to be decreased for maybe another half decade, depending how things go here. But that's just kind of the mode that I'm operating with. So those are just some additional lessons about what we learned on this one. Again, we'll see if it goes through, but just wanted to update you what we did for this particular parcel and, at least how we handled getting under contract here and what actually worked well. That days on market reset timer, use it to your advantage. It's worked 3 times for us. So there's definitely something to it. With that in mind, seriousland.capital for any of your funding needs, zero cost review of your land deals, Land Daily Diligence Facebook group, and landpricer.ai, about to hop on a meeting with my engineering team right now. With that, take care, everybody. Subscribe and share. Give me a nice rating on the podcast platforms if you feel I deserve it, so we can reach more ears who want to learn. With that, take care. Talk to you next time. Bye.